Palantir Technologies has recently turned profitable, showcasing strong cash flows and solid profit margins. Yet when we apply our valuation models, we find negative equity per share. Is this a sign that Palantir is an undervalued opportunity poised for significant growth, or is it overvalued in the current market landscape? Join us as we examine the company's financial statements and explore its future prospects. To begin, let's take a closer look at what Palantir Technologies does and what makes it unique. Founded in 2003, Palantir Technologies Inc. is a data analytics company specializing in creating software platforms for government and commercial clients. Data analytics involves examining raw data to uncover patterns and draw meaningful insights. Palantir's platforms integrate and analyze complex datasets from various sources, enhancing decision-making processes. Their solutions are critical in areas like counterterrorism, helping identify potential threats before they occur, fraud detection in financial systems, and optimizing supply chains for greater efficiency. Turning to Palantir's financial health, the company demonstrates a strong liquidity position with cash and cash equivalents totaling $768.7 million as of September 30th, 2024. Liquidity refers to how easily a company can meet its short-term obligations, and this substantial cash reserve reduces the need for external financing, thereby supporting ongoing operations. The company's debt has decreased to $302.5 million, resulting in a positive cash minus debt balance of $466.2 million. This indicates a strategic focus on financial flexibility. The absence of preferred stock in their capital structure shows a conservative approach to financing, and the recent $1 billion share repurchase authorization reflects a commitment to enhancing shareholder value. Although retained earnings are still negative, they have improved this quarter, signaling enhanced profitability. An improved debt-to-equity ratio of 0.056 indicates effective debt management. Overall, this prudent financial approach positions Palantir to withstand economic challenges and invest in strategic growth initiatives. Examining Palantir's balance sheet in more detail, we notice that the company's current ratio, the ratio of current assets to current liabilities, is robust. This suggests strong short-term financial stability, meaning Palantir can comfortably meet its short-term obligations. Additionally, improved management of accounts receivable enhances liquidity, ensuring that cash flows remain steady. Accounts receivable represent money owed to the company by its customers, and efficient management ensures these funds are collected promptly, which is crucial for maintaining liquidity. With non-current liabilities, such as long-term debt, remaining low, Palantir mitigates long-term risks and supports its ability to make strategic investments for future growth. Moving on to the income statement, Palantir's financial performance appears robust. The company boasts a strong gross margin of 79.8%, indicating that it retains nearly 80 cents of every dollar of revenue after accounting for the cost of goods sold. Gross margin reflects the efficiency of production relative to sales. Notably, selling, general, and administrative expenses have decreased to 48% of revenue, highlighting effective cost control measures. SG&A expenses include costs related to selling products and services and general administrative expenses necessary for operations. This reduction contributes to a higher net income margin of 19.8%, showcasing enhanced profitability. While earnings per share growth remains stable, the significant increase in revenue, driven by a 33% growth in government contracts and 27% in commercial sectors, underscores strong market demand for Palantir's solutions. The company's focus on operational efficiency suggests sustained profitability ahead, though it remains prudent to monitor stock-based compensation and subcontractor costs. Overall, Palantir demonstrates promising operational performance. A closer look at the full income statement reveals a substantial increase in revenue, emphasizing Palantir's ability to capitalize on market opportunities. This growth demonstrates the company's effectiveness in expanding its client base and enhancing its offerings. Furthermore, Palantir has increased investment in research and development, indicating a strong commitment to innovation, a critical driver of long-term success in the technology sector. Investing in R&D allows companies to develop new products and services, stay ahead of competition, and adapt to changing market demands. While the company has faced net losses in the past, the recent move into profitability marks an important milestone. However, it's essential to assess the sustainability of this profitability over the long term, as ongoing investment and market fluctuations could impact future performance. Palantir's consistent growth in revenue and the recent improvement in net income signal strong financial health. This upward trend reflects the company's strategic expansion in government contracts and diversification into commercial markets. Government contracts often provide stable and predictable revenue streams because they are less susceptible to economic fluctuations. The enhancement in profitability suggests efficient management of costs and resources. Despite broader economic uncertainties, management anticipates sustained resilience in government contracts, which supports ongoing revenue growth. Their focus on deepening customer engagement and advancing technology, particularly in the field of artificial intelligence, positions them competitively in the market. When compared to industry peers, Palantir's ability to grow revenues while improving profit margins is a positive indicator. For value investors, such operational efficiency and strategic positioning are crucial factors when evaluating a company's long-term potential. Another key aspect of Palantir's financial health is its strong free cash flow, which amounted to $415 million in the latest quarter. Free cash flow represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. This robust cash-generating ability highlights the company's exceptional financial efficiency. With a free cash flow yield of 24%, indicating that Palantir generates significant cash relative to its market value, the company is well positioned in terms of liquidity. A modest capital expenditure margin of 2.8% shows disciplined investment that aligns with strategic priorities without overextending resources. While stock-based compensation is substantial at $142 million, it is managed effectively to retain top talent while maintaining financial sustainability. This healthy cash flow enables Palantir to capitalize on new opportunities without accruing additional debt, preserving a conservative capital structure that acts as a buffer against economic uncertainties. It also provides flexibility for reinvestment or returning value to shareholders. Looking at the full cash flow statement, Palantir demonstrates significant improvement in its cash generation from core operations. Net cash from operating activities has risen to $693 million, up from $411 million in the previous year. This substantial increase indicates a strong operational foundation, suggesting that the company's core business is generating more cash. Net cash from operating activities measures the amount of cash generated by a company's regular business operations, indicating whether it is sufficient to maintain and grow the business without requiring external financing. Such consistency and growth in operational cash flow are vital for supporting future expansion and providing stability during economic fluctuations. This trend is particularly appealing to value investors who seek companies with solid fundamentals that can enhance long-term shareholder value. In its recent earnings call, Palantir Technologies showcased a robust financial performance that exceeded market expectations. The company reported significant revenue growth, fueled by increased demand for its data analytics platforms in both government and commercial sectors. Notably, Palantir achieved profitability, a milestone that highlights the evolution of its business model from a focus on growth to a balance with profitability. Management emphasized the expansion of long-term contracts, which provides the company with more predictable and stable future cash flows. However, it's important to note that operating expenses remain high, which impacts overall profit margins. While high operating expenses are a common challenge in the technology industry, often due to ongoing R&D and expansion efforts, it's crucial for Palantir to address these costs to enhance shareholder value. Compared to competitors, Palantir's strong relationships with government agencies offer a unique competitive advantage, but also introduce regulatory risks and potential fluctuations in government spending. For value investors, the key takeaway is the company's progression towards sustained profitability, while balancing the need to manage operating costs and mitigate potential external risks. Looking ahead, analyst estimates project a steady rise in Palantir's net income and earnings per share over the coming years. Specifically, net income is expected to reach $1.09 billion, with EPS hitting 46 cents by 2025. Earnings per share is calculated by dividing a company's net income by the number of outstanding shares, providing a measure of the company's profitability allocated to each share of common stock. The stability provided by government contracts, which tend to remain secure even during economic downturns, supports these optimistic forecasts. However, it's important to consider risks such as changes in government spending priorities and geopolitical factors, which could impact the company's performance. Palantir's focus on innovation and strategic partnerships could enable it to surpass these projections, provided that market conditions remain favorable and the company continues to execute its strategy effectively. When we analyze Palantir's valuation metrics, we find that its price-to-earnings ratio is significantly higher than those of its peers, such as Palo Alto Networks and Adobe. The PE ratio is calculated by dividing the current market price per share by the earnings per share and is used to determine whether a stock is over or undervalued. A high PE ratio often indicates that investors expect substantial future growth, but it can also suggest that the stock is overvalued relative to its earnings. Similarly, Palantir's price-to-book ratio is elevated, indicating that the stock trades at a premium compared to the company's book value, the net asset value of the company. These high valuation metrics raise concerns about the alignment between the market price and the company's intrinsic value. It's important to note that Palantir has a unique multi-class share structure that concentrates voting power with management. This structure allows management to focus on long-term strategic objectives without undue pressure from short-term market influences. For investors, it is crucial to consider whether Palantir's ongoing innovations, particularly in the field of artificial intelligence, will justify and sustain these high valuations. The company's ability to maintain its competitive edge through technological advancement and market positioning is key to its future performance. Conducting a discounted cash flow valuation, which estimates the value of an investment based on its expected future cash flows, we modeled base, optimistic, and pessimistic scenarios for Palantir. A DCF analysis involves forecasting a company's free cash flows and discounting them back to their present value, providing an estimate of the company's intrinsic value. Notably, all scenarios resulted in negative equity values per share, ranging from negative $6.85 to negative $10.27. This outcome underscores the challenges Palantir faces in achieving a positive intrinsic value based on current projections. Bridging this valuation gap requires management to sustain their competitive advantages and maintain a strong focus on innovation and market expansion. The negative valuations highlighted the need for sustained revenue growth and improved profit margins to enhance intrinsic value. Despite these challenges, Palantir's strategic investments in technology and its unique market positioning could offer significant long-term potential. Realizing these opportunities will depend on the company's ability to execute its strategies effectively amid competitive pressures and economic uncertainties. Analyst forecasts for Palantir over the next 12 months suggest a wide range of potential stock prices, with a high target of $75, an average of $40.30, and a low of $16. This range reflects potential market volatility, but also indicates significant upside potential. These projections align with management's optimistic growth outlook, which is driven by strong client relationships and ongoing technological innovation. Historically, Palantir's stock price surged from $9.50 in September 2020 to $76. By December 2024, propelled by successes in both government and commercial sectors. Looking ahead, challenges such as geopolitical tensions and economic shifts could impact customer spending and market conditions. Therefore, diversification of the client base and continued strategic innovation are essential for the company to meet or exceed these projections. In conclusion, Palantir's strong liquidity position, improving profitability, and strategic investments in artificial intelligence uniquely position the company for long-term growth. However, the elevated valuations and challenges in assessing its intrinsic value suggest that cautious optimism is warranted. For value investors, balancing these factors, recognizing the company's potential while being mindful of the risks, is essential. Thank you for joining us in this analysis. If you found this insight valuable, consider subscribing to stay updated on future deep dives, liking this presentation, and sharing your thoughts below. Together, we can continue to explore and understand the complexities of the investment landscape.